Hi everyone, we put together the top 10 key steps for doing a 1031 exchange here in this video. But if you are hungry for more, do check out the top 10 tax tips when doing a 1031 exchange in the resource section. It's a downloadable. So number 1, understanding the basics. Before diving into a 1031 exchange, it is crucial to have a solid understanding of the process, rules, and timelines involved. This includes being well-versed in the guidelines set by the IRS. So by taking this course, you are already setting yourself up for this point. However, to navigate this complexity effectively, it is highly recommended to seek guidance from professionals such as a qualified intermediary and a tax advisor. Their expertise can ensure that you comply with the regulation and make the entire process smoother. Tip number 2. Identify replacement property early. One of the keys to a successful 1031 exchange is starting the search for the replacement property as early as possible. The exchange has strict timelines for both identifying and closing on replacement property. This will give you ample time to explore options and make well-informed decisions. And remember, if you are an accredited investor, DST is available to you. So do explore that as a backup option. Third, diversify your portfolio. Consider exploring different property types, locations, and even varied asset classes that align with your investment goals and risk tolerance. Diversification can be a powerful strategy to reduce risk and optimize your overall investment portfolio. Fourth, consider value add opportunities. When identifying replacement property, it is worthwhile to seek out opportunity in value appreciation. This could involve properties for the potential improvements or renovations. By strategically choosing assets that can grow in value over time, you enhance the long-term profitability of your real estate portfolio. So I can include a list of potential opportunity in the resource section, so be sure to check them out. Fifth, explore Delaware Statutory Trust DSTs. As mentioned earlier, Delaware Statutory Trust offer a unique avenue for passive investment in institutional-grade property. This can be particularly attractive for investors who seek to defer taxes without taking on the active management responsibility associated with direct property ownership. So check out that DST section in the course if you haven't already done so. But remember, this type of investment is only available to accredited investors, and we do define what that means in that section. So 6, use multiple properties as replacement. As mentioned earlier, investors have the option to identify up to 3 and acquire more than 1 replacement property. This is the general rule, but with the additional identification rules, you have more options. If you only identify 1 and the deal doesn't go through, what are you going to do, right? So you would have to pay tax like a regular sale and purchase. But if the IRS allows you to identify 3, then do that to maximize your chances. 7, use reverse exchanges. In reverse exchange, you can acquire the replacement properties before selling the relinquished property. Reverse exchanges are often used in cases when you must close on the purchase of a new property before being able to sell your current property. 8, be mindful of debt replacement. A critical consideration in 1031 exchange is ensuring that the debt on the replacement property is equal to or greater than the debt in the relinquished property. Failing to do so might result in a taxable gain, as the IRS views a reduction in debt as equivalent to receiving cash. This careful management of debt is crucial for maintaining the tax benefit of the exchange. 9. Accounts for BOOT. It is important to be aware that BOOT is subject to capital gains tax. To minimize or eliminate the impact of BOOT, investors should carefully structure the exchange. Number 10. Stay compliant with 1031 exchange rules. So last but not least, Strict adherence to the timeline and rules set by the IRS is paramount for successful 1031 exchange because this is very strict. It's also about record keeping is key to have a valid 1031 exchange. So if you fail on any of these requirements that the IRS have for you, you might risk disqualify this exchange and then all gonna be in the muddy water with all the capital gain tax you have to pay. So this involves collaboration with qualified professional, including qualified intermediary and a tax advisor. So their expertise ensure compliant and a smooth exchange process, ultimately safeguarding the benefit of the 1031 exchange for your real estate investment. So I hope you find these tips helpful. Now it's time to transition to the next video.